Dion, it's Tom. I I messed up. You were right. I should have listened. I locked into fixed at 4.5% like my bank told me to, and now variable just dropped to 3.6%. I'm paying $380 more every month than I need to. That's that's over $22,000 over 5 years. My wife she's furious. We could have used that for our kids' education. I don't know what to do. Call me back.
I told him not to. 3 weeks before he signed that mortgage, I sat across from Tom. I showed him the numbers, I showed him the scenario, and I asked him one question. One question that would have saved him $22,800. But he didn't answer it honestly. And his bank, they never even asked. And right now, in 2026, thousands of Canadians are making the exact same mistake because nobody's asking them this question. But here's what's crazy: some people should go fixed, and some people should go variable. But 90% of you are choosing based on the wrong thing. You're looking at rates, you're listening to your bank, you're asking your friends, but you're not asking yourself one question. The question that determines whether you save $20,000 or lose $20,000. And I'm going to tell you that question, but not yet. Because if I tell you now, you think you know the answer. You'll think, yeah, I got this, just like Tom did. And then in 6 months, you'll be leaving me a voicemail, just like Tom did. So here's what we're going to do. In the next 10 minutes, I'm going to walk you through exactly how to make this decision. I'm going to show you the math. I'm going to show you the psychology. And at the end, I'm going to reveal the one question you need to ask yourself. The one question your bank will never ask you. The question most mortgage brokers don't even know to ask. The question that separates people who save 20,000 and for people who lose 20,000. And if you stay to the end, I'm going to give you the exact calculator I used with Tom. The calculator that would have saved him 22,800 if he actually used it honestly. It's free. It takes 3 minutes and it will tell you with zero guessing whether you should go fixed or variable. I'm Dion Williams with Williams Mortgage. I've helped over hundreds of Canadians make this exact decision. And I've seen what happens when people get it right and when people get it wrong. Don't be Tom. Let's get into it. All right, before I show you the framework, you need to understand why Tom made the wrong choice. Because it wasn't about rates. When Tom came to me, here's what rates looked like: fixed 4.5%, variable 3.8%. Variable was about 0.7% cheaper. And I told Tom, look, if you go variable, you'll save about $200 a month right now. But then I asked him the question, and Tom said, yeah, I think I can handle it if rates go up. I think? Not I know, not I've run the numbers. I think. That's where he messed up because Tom didn't answer honestly. He went to his bank. His bank said fixed is safer, lock it in. And Tom thought, yeah, that makes sense. I'll sleep better. So he locked in at 4.5%. 3 months later, variable rates dropped. And now Tom realized he's now paying $380 more every month than he needs to. Over 5 years, that's $22,800. But here's what kills me: it wasn't the bank's fault. The banks did what banks do. They showed him rates, they recommended fixed because it's safer, they got him approved. But they never asked him the one question, the question that would have revealed Tom should have gone variable. And that's not Tom's fault either. Because how was he supposed to know? Nobody taught him how to make this decision. So he guessed. And guessing cost him $22,800. But you're not going to guess because I'm going to show you exactly how to make this decision. No guessing, no hoping, no, I think, just data. So let's start with the basics. All right, quick education here. Fixed rates track government bond yields in Canada. If you want to know where 5 year fixed rates are going, you just look at the 5 year government bond yields. Right now, those yields been bouncing around. We broke above some key levels back in 2016. And lately, we've been trading sideways. What does that mean for you? It means fixed rates could climb higher if bond yields spike, or If they stay flat, yields keep trading sideways. Nobody knows for sure. Now, variable rates, they're based on the Bank of Canada's prime rate. The bank meets 8 times a year, and at each meeting, they could raise, lower, or hold the prime rate. When prime rate goes up, your variable rate goes up. When prime rates go down, your variable rate goes down. So your payments can change. And here's where most people freak out because here's the thing, that flexibility can actually save you money or cost you money. It all depends on what the Bank of Canada does. And right now in 2026, nobody knows what they're going to do. Inflation's still a factor, housing market's cooling, sales are down, prices are flat about $670,000 nationally, new listings are slowing, so the Bank of Canada could raise rates to fight inflation, or they could lower rates to stimulate the economy. It's a coin flip. But here's what you need to know, the math, because the math tells you right now big Canadian banks are offering 3.99 for a 5-year fixed and about 3.55 for a 5-year variable. That's about a 0.44% gap. Now, here's where it gets interesting. The Bank of Canada usually changes prime rate in quarter basis point increments, so about 0.25% at a time. That means the prime rate would need to go up about twice before the variable rate catches up to what you'd pay on a fix today. 2 rate hikes. Now, could that happen? Absolutely. In fact, economists think we could see rate hikes as early as 2027. But here's the question, if rates go down or go up twice over the next 2 years, can your budget handle it? Let me show you what it looks like in real dollars. Say you have a $500,000 mortgage at 3.55% variable. Your payment's 25.09 and 27 cents a month. But if rates go up at 0.5%, 5-year rate hikes, your rate becomes 4.05%. Your payment now is $2,643.67 a month. That's an extra $134 a month. Can you afford that? More importantly, will that stress you out? Will you be checking the Bank of Canada's website every month, wondering if payments are about to jump? Because if the answer is yes, variable's not for you. But if you can handle that $134 increase without breaking a sweat, and you have an emergency fund that could cover you for 6 months, if things get tight, then variable rate might save you thousands. But historically, variable rates have been cheaper over the long haul. But, and this is important, most people lie to themselves about this. They say, yeah, I can handle a $134 increase. But they haven't actually looked at their budget. They're guessing, just like Tom. So, how do you not guess? That's what I'm about to show you. All right, here's the framework I use with every single client. It's 2 questions. That's it. Question one, can your budget handle a 1 or a 2% rate increase without a major stress? And I don't mean technically afford it. I mean, can you handle it without cutting into your emergency fund, maxing out your credit cards, losing sleep at night, fighting with your partner about money? If the answer is yes, variable might be your move. If the answer is no, lock in fixed. Simple as that. Question two, will you lose sleep over your mortgage payment potentially going up? And be honest with yourself here. Some people can handle uncertainty. They check rates, they adjust their budget, and they move on. Other people, they're checking the Bank of Canada website every week. They're running scenarios in their head. They're worrying. If that's you, lock in a fixed. Because no amount of potential savings is worth your mental health. Your mortgage should give you peace of mind, not anxiety. So that's the framework. 2 questions. Can your budget handle a rate increase? Will you lose sleep over it? If you answered yes to both, variable. If you answered no to either, fixed. But here's where Tom messed up. He didn't run the numbers. He just guessed. Yeah, I think I can handle it. Don't guess. Ask your mortgage broker or your lender to run the numbers for you. Say, show me what my payment would be if rates go up 1%. Show me at 2%. Then look at the numbers and ask yourself, can I actually afford this? Will this stress me out? That's how you make a smart decision. Not by guessing, not by hoping, by knowing. Now, let's get in. Let me give you some context for 2026 because The market right now is weird. Quick market update: home sales are down. Prices are flat, averaging about 673,000 nationally. New listings are slowing. The market's in a holding pattern. And when the market's uncertain like this, flexibility becomes more valuable. Because if you lock in a 5-year fixed right now and the rates drop in 6 months, you're stuck. You can't take advantage of the lower rates without breaking your mortgage and paying a massive penalty. But if you go variable and rates drop, your payment drops automatically. No penalties, no refinancing, just savings. That's the upside of variable. But the downside, if rates go up, your payment goes up. And you have to be okay with that. So in 2026, with all this uncertainty, the decision comes down to two questions I gave you: budget and risk tolerance. That's it. Now, remember at the beginning, I told you there's one question? The question I asked Tom, the question that would have saved him $22,800. You ready for it? Because this is the question that changes everything. All right, here it is. The question nobody asks when choosing between fixed and variable, it's not which rate is lower. It's not which one will save me more money. The real question is, what's my pain threshold? Let me explain. Your pain threshold is the maximum monthly payment increase you can handle without it affecting your quality of life. Not just afford, without it affecting your quality of life. Here's how you find it: you take your current monthly budget, look at your expenses, minus your expenses. So we're talking mortgage, bills, groceries, savings, fund money, everything. What's left over? That's your cushion. Now, if your mortgage payment went up by that cushion amount, could you handle it for 12 months? If yes, that's your pain threshold. Let me give you an example. Say your monthly income is $8,000 and your expenses are about $6,500. That leaves you with about $1,500 cushion. If your mortgage payment went up by $1,500 a month, you'd be at zero cushion. That's not sustainable. So your pain threshold is probably more like $500 to $700. That's the maximum increase you can handle without sacrificing your quality of life. Now, here's where it gets powerful. Once you know your pain threshold, you can calculate exactly how many rate hikes you can handle. Say your pain threshold is $500, and at each 0.25% rate hikes adds about $50 to your payment. That means you could handle 10 rate hikes. 10 rate hikes before you hit your pain threshold. Now, do you think the Bank of Canada will raise rates 10 times in the next 5 years? Probably not. So variable might be a great choice for you. But if your pain threshold is only $200 and each rate hike adds $50, you can only handle 4 rate hikes. And 4 rate hikes could happen in 18 months. So for you, fixed rate is a safer bet. This is the question I asked Tom. Tom, what's your pain threshold? And Tom said, I don't know. I think I can handle a few $100s. I think he didn't know. He guessed. And because he guessed, he went with what felt safer: fixed at 4.5%. But if Tom actually ran the numbers, if he'd looked at his budget and said, I have a $1,200 cushion, my pain threshold is $800, he would have realized he could handle 16 rate hikes. 16! And the Bank of Canada wasn't going to raise rates 16 times. So variable was the right choice for Tom. But he didn't know his pain threshold, so he guessed. And guessing cost him $22,800. Don't be Tom. Know your pain threshold. Look, I know this is a lot. Pain threshold, cushion, rate hikes, it can feel overwhelming. That's exactly why I created a free calculator that does it all for you. You plug in your income, your expenses, your mortgage amount, and it tells you your pain threshold. How many rate hikes can you handle? Whether fixed or variable is better for your situation. It's the exact tool I used with Tom. The tool that would have saved him $22,800 if he'd actually used it honestly. And I'm giving it to you for free. Click the link below right now and I'll send you the calendar plus a custom breakdown of your situation. Because here's the thing: this decision is too important to guess. Tom guessed, It cost him $22,800. Don't be Tom. Click the link, get the calculator, know your pain threshold. Because the difference between fixed and variable isn't about rate, it's about knowing your numbers. And now you do. I'm Dion Williams, and I've helped over hundreds of Canadians with this exact decision. And I want to make sure I help you too. Click the link below, get your free calculator. And let's make sure you never leave me a voicemail like Tom did.